Hi, everybody. This is Don Vandenbord. It is, as you know, Wednesday 10/9. This is the fifth in the series of Lunch and Learn presentations. If you can hear me okay, go ahead and type in the questions. Yes, I can hear you fine. Just want to make sure the audio is going out okay. And yes, this is recording just fine. So a recording of this will go out to everybody that's a live attendee and also to everybody that is signed up to get the archive. So I've got 12 o'clock and I like to be prompt, so I'm going to go ahead and get started. First of all, I guess I can fix the date because it's not 10/8, it's 10/9. Reminder, of course, this is for educational purposes only, not suggesting that anybody buy or sell anything talked about on this. The purpose of these is to reach out to the stock nerd client and market lover community with some insight into our process at Revere. I feel very fortunate to be able to work with Danny and Tim to spread the word that people don't have to take a beat down when the market is not in their favor. There are ways of identifying it, and what I do is walk through the process that we go through. Let's get back to the agenda. Just want to go through it very quickly. So we did the secondary indicators. We'll talk about some watch lists, but first we're going to go through the indexes, and then the components to monitoring sector rotation. We're going to look at large versus small caps and growth versus value, and there's a couple of ETFs that I use to monitor that. And then you start with the overall market. The market's made up of 11 spider sectors, 33 IBD sectors, and 197 IBD industry groups that we track. And the questions you want to ask yourself is, where are we? Where were we, or where is it? Where was it? And how long was it there? Because you don't want to be getting in late in a move just because you're buying something that's in the top 10 industry group. If it's been there for months and it's actually starting to lose relative strength, it's something you want to stay away from. And charts, we'll talk about some in-house holdings that we have, and somebody asked that we do charts of the Fang Stocks, and then I'll take questions and answers and do charts on request. So let's start out with the S&P 500 here. I'm going to blow this up to the 60-minute level, and this 2940 area, this goes back a while. This has been an area, this 2940 to 2960 has been an area of a battleground. You can see we broke above it, tried to test it. We held 2960, came a little bit lower, but never broke 2940. And then last week, we gapped down below it. This spike level coincided with the test of the 200-day moving average and this 2840 test. That held. This is when we started with some extreme sentiment readings. We started getting back in and buying a couple things. We broke back above this neutral zone area, 2940 to 2960, failed, gapped below it yesterday, and again with this morning's gap up, we're trying to make an attempt to get back into, and we want to be watching what happens when we get up to this 2940 area. So for now, 2940 to 2960 have been a good area to get short or hedge longs. So that's something we're keeping a close eye on now. But you can see here as I zoom in that the 21-day declining exponential moving average here has been serving as resistance along with this 2940 to 2960 area, and you can see the 50-day moving average, which is the red line, has rolled over also. The black line is the 200-day moving average. The purple line is the 150. So let's take a look at the NASDAQ 100, the QQQ. Very similar situation. I've been talking about this for a while, how the 21-day exponential moving average is providing resistance on the upside, and now it's moving in tandem with the 50-day moving average, which has also rolled over. We're not going to make any significant progress on the upside until we can decisively break back above these, but a little bit of a positive, you can see that tech has been leading for about the last 8 sessions as the QQQ is showing relative strength off of the bottom. Dow Jones Industrial Average, same situation. 21 has rolled over, 50 has rolled over. They're acting as resistance on any move back up into it. Mid caps, looking at the MDY ETF, certainly stronger than small caps, but weaker than the large caps in the same situation. The 50 and the 21 rolled over, acting as resistance. And small caps, which really haven't even come up to test the declining 21 over the last week and a half, the way the other indexes are, and we're stuck below the 200-day moving average on this. Really need to see some participation in the small caps. As I get back to the regular size charts here. So that's the S&P 500. As far as the watch list, I'll quickly go through the 21 over 21 list. And you're going to see some stocks that are acting pretty well, a couple that I've added to it this week just to monitor. They haven't officially been added. What I do is clean it up at the end of the week. Crocs acting pretty strongly. This building stock has been trending higher, BLD, for a while. MDC, home builders, holding above the 21. Tim had some nice exposure to the home builders via ITB for a while. He caught that turn very well. Pulte, another home builder, acting very well. Taiwan semiconductors have been outperforming. Look at the relative strength on this one. ASML, another semiconductor, holding the 21 EMA. Teradyne, another semiconductor, same situation. Jabil, contract manufacturing for electronics, had a nice gap up, is acting well since then. Energy tanker, Scorpio tankers, transportation and shipping and energy shipping have been acting very well lately. CHDN, Churchill Downs, they've got something new going on in them as far as being able to do online gaming licensing, and you can see the stock acting very well with some volume and relative strength showing. Celgene, they're involved in, it's not necessarily takeover, I think it's a merger with a larger company, and I haven't done enough research on it, but this is standing out from a relative strength standpoint versus the rest of biotech, which really is not good. You can see the industry on biotech being 115. CPRT, breaking down from the 21, so by the end of the week, if that continues, it'd be taken off the 21-21 list. Dollar General, something owned in-house, acting very well. This is something that was purchased in Grotection off the 21-day EMA last week when we started putting money back to work. Lululemon on the watch list, holding the 21. RH, also something, took a position in Grotection off of the 21 last week when we put some money to work, acting nicely. Costco, we own this in pretty much every portfolio in-house now. Very nice reaction off the 50 and back above the 21-day exponential moving average on their earnings report last week, which initially was a shakeout, and it's now testing the 300 level. Proofpoint, one of the best acting security stocks, holding around the 21. These have been a little bit volatile lately, but there is relative strength showing in there. OKTA. This is something that's on my watch list because it's been one that held up pretty well, came back above the 200-day moving average, back above the 21, but you've got the declining 50 as resistance. So some of these better acting software stocks that held up, that didn't get completely devastated anyway. This is down about 35% at the correction, but now building a flat base. Activision, gaming stock, bounce off the 50, holding the 21. Coupa Software, this is really probably the best acting software stock. Not much of a give back at all in its strong move. FSLY, this is a very volatile software stock, but interesting volume patterns, and people were really buying it here out of this double bottom base. DocuSign, biggest position in the Grotection portfolio right now, and was something that was bought last week when we again put money to work and acting very well. ServiceNow, another software stock that held the 200-day moving average and is back above the 50 and the 21 now. Akamai, software stock, got back above the 21, but not holding it. As you can see, the 21 rolling over. Apple, best of the big cap tech stocks acting out there. Took a little bit of a hit back here based on some China issues and around earnings, but has reclaimed all of it. And you can see very nice relative strength since its earnings report. And Frontline, another shipping company. This I don't normally buy stocks that are under $20, but there is a nice group move going on here in the shippers. So that's the watch list. Let's go into education. And first thing is, of course, you want to know where the market is. And I primarily use the S&P 500 and the NASDAQ 100 to determine how things are going here. And as I showed in the state of the market, we're just in this big consolidation. In fact, we've gone basically nowhere since we topped early last October. I think the market is either plus or minus 1% from that level. When I go into some comparison charts in a little bit, we'll be able to see that here. But the S&P 500, until we had this breakout back here about 3 weeks ago, but then the 3,000 and prior highs here turned into resistance. We weren't able to make a move above it. Then some China headlines came in, some impeachment talk, and we rolled over any attempt to get back above the 21, and now even the 50-day moving average has not worked. So until we get back above this 29.60 level and these moving averages, it's been some tough sledding. There are some stocks that are working. I just went through some of them in the hold on a second. I just got an email from somebody that's trying trying to attend. Okay. So until we get back above this level, is 29.60, and the EMAs, there's going to be an issue with the market making any headlines, or making any strong progress. But some of the things that are flagged in here on the watch list are things that own in-house, and when you see some improvement in the market, we start dipping a toe in, and as long as it continues to work and we don't get stopped out, we continue to build on the successes of those initial positions taking, and Docu and Roku have been some that have acted very well as Costco. So let me use the SPY as the ETF for the S&P 500. We're going to do a comparison here, and these IBD comparison charts are something I'm extremely fond of. So what I want to show is the S&P 500, and then I want to show the small cap proxy, the IWM. You can see this is over the last year. I'm going to take this back to 10/1 of last year, which is right around where we topped. You can see the S&P 500 or the SPY down 0.24%, but the small caps have been lagging much worse, down 11.6% since the beginning of October of 2018. Now let's bring in the value and the growth ETFs. First, for the S&P 500, IVE is the S&P 500 value ETF, and you can see that's moving kind of in line with the S&P 500, but we're going to cut down the time period here, and you can narrow it down and see what happens during different time periods and see how money flows from one to the other. Now I'm going to bring in IVW, which is the S&P 500 growth. Then IWN is the Russell 2000 value ETF. You can see, again, not acting well compared to the larger cap indexes over the past year. And IWO is the Russell 2000 growth ETF, again, acting a little bit better, but certainly worse. So this tells you over the last year, not a good situation at all for small caps versus large caps. But so first, let's take this to 12/31/2018, and look at the carnage from the fourth quarter of last year. You can see large caps down 14.3%, Small cap Russell 2000 down 19%. Large cap indexes corrected less than the small cap indexes corrected. So now let's go to year to date on all of these. And you can see how not only did small caps perform worse during the critical fourth quarter of last year, they've also performed less to the upside versus large caps over the period of this year. You can see S&P 500 up 16% versus only 9.8% for the small caps. But something changed in the beginning of the third quarter of this year. So let's just particularly look at the third quarter here. And you can see from an overall perspective for the whole quarter, small caps still underperformed. But now let's take it to just January. September 9th of this year, January. Let's take it back to the beginning of September, because there was a big shift. I didn't take that. Let's take it to 8/30/2019. And you can see here the change. This area right here, September 9th, was when the big money flow out of momentum and into value, particularly on a small cap basis, but mostly particularly on small cap, but also in the large cap value had money flowing into it. You can see Russell 2000 value up 1.3%, while growth is down 3.56% over the last 5-6 weeks. Large cap growth down 1.6%, large cap value up 0.73%. So really a move into value and small caps. It started out money flowing into small caps, but we've given most of that up since this big peak here in September. There's been underperformance again by small caps. So, but definitely still a move into value versus growth. So we've evaluated large and small, growth and value. Then we want to take a look at spider sectors. So there's an acronym that I use to just go through these. And we're going to see let's go back to over the last quarter, and we're going to see where money has been flowing from a sector standpoint. XLB down 2% versus, I'm going to take down 2% versus the S&P 500, so it's been underperforming. XLE, energy, very volatile, down 1.6%. Financials, money flowed into financials and oil in particular while we were flowing into this value trend. You can see XLF positive over this time period. XLI, industrials, underperforming. XLC, commercial services sector. This is dominated by Facebook. XLK, tech, doing pretty well. XLP, consumer staples. Let me move this back to, okay, this is at the 8:30 area, so that's good. This is over the past 6 weeks. XLRE, real estate, positive. XLV, healthcare, negative. And consumer discretionary, XLY, kind of in the middle. I monitor this on a weekly basis and change up the time frames constantly to see really what's been happening in the over different time frames. And there are things that jump out, particularly right here and here. This represented the rotation into sector versus the declining growth. And then that took about 3 days, maybe toward the end of that week when it happened, and then things started separating out again. But I run this constantly. This looks really like a jumbled mess, but I'm constantly running this screen to see where the money's flowing across the 11 sectors. And then the next, let me close this, the next breakdown of spiders is the 33 sectors that IBD uses. If you look at the, if you get the paper on a monthly basis, I'm sorry, on a weekly basis, they do it in print, but they list in sector order where the strongest sectors are. And then those 33 sectors are broken down to 197 industry groups. So let's take a look here at a screen of the 197 industry groups, and this is ranked by ranked in ascending order by industry group. And let's talk about some of the things that we're monitoring in-house here to see where the strength is coming. First of all, this relative strength can be very misleading. I'm going to point out first of all, some flaws in this approach. One is that it's price weighted, and if there's an industry group that has a very few number of companies in it, and I keep a list of the major ones that I'm concerned about in each of these, it can really skew the performance. So you have to do some digging down to see what's going on in some of these when they become very highly rated or very lowly rated. Also, I'm monitoring the trend, relative strength. You've heard me talk about it 1,000 times. I'm monitoring the trend from the year-long relative strength to the 6-month relative strength, and I'm really keying in on the 3-month relative strength. Here, another column in this sort is the industry group percent change over the last 3 months, where the industry group ranked last week and where it ranked 3 months ago, and then where it ranked 6 months ago. So you can see the trend. Like, for example, let's take a look at this retail major discount chains. 6 months ago, it was ranked 131st. 3 months ago, 45th. Last week ranked 8th. This week ranked 4th. It's been up 13% over the last 3 months. Very nice. And its relative strength has been consistent over the 1 year, 6 month, 3 month. Anytime we see, like, look at this aerospace defense, this is something it's now ranked 10th, but from a relative strength perspective over the last 3 months, this is really a laggard, only outperforming 57% of the all stocks that make up the entire universe. And also the industry groups that are included in that universe. So as you scroll down here, I'm looking for not only things that are highly rated, which is where is it, I want to know where was it and how long has it been there. So as we scroll down, some things that are not ranked very highly at the present time, but where were they? For example, here's another one, finance, mortgage, and related services. This is something that has a group 80, but 3 months ago was 6. 6 months ago it was 2. So as this is looked at on a weekly basis, you can see things start to deteriorate, and you really don't want to. This is something that goes into setting our stops and our sell strategy. 50% of a stock's move, 32% of it, I believe, is tied to the overall sector, and then 17% is to the industry group within the sector. These are IBD stats. So you can't look at your stock always in a vacuum as far as how it's acting. You want to see how sister stocks in the sector and more particularly in the industry group are behaving. So let's just scroll down here and see some other things that are deteriorating. Commercial services, healthcare, now with a 20 relative strength over the last 3 months. Now let's go to the bottom of it and see if we've got anything where the strength is really picking up. Again, there's 197 of these groups, so we'll go down to the bottom. The least ranked sector, retail order, relative strength rating. When you see a very low relative strength rating here, that means everything is basically outperforming it. But look at this retail, wholesale, office supplies. Oh, that jumps out at you, but there's only one stock in the group. So that's misleading in and of itself. They should really get rid of that group and merge it in with something else. And I'm always on the lookout for something that is increasing off the lows, because if you see that, you're going to see the possibility of some standout stocks coming up, maybe the right side of their base. You can get a descending trend line break and possibly an early entry if it starts to improve, especially if you see one or more stocks start to improve on it. Here's retail department stores. Relative strength, if you looked at the chart of this, in fact, let's bring up this chart. Retail strength has improved from a 12 to a 72 to a 91 over the last 3 months, while the group is still at 175. This tells me that this is a group that's coming off the lows. And you can see here how the relative strength has been improving in this group. So let's dig down a little further. What are the stocks that are in this group? Well, the standout here is going to be Dillard's. You see it's got a relative strength of 60, but again, that is just that's the yearly relative strength. But you can see Dillard's came off the bottom, got back above its 21, the 21 crossed over the 50, and it came up off the 200-day moving average. If this is really a handle in a longer base, the numbers don't look good here, but maybe they're improving, maybe there's been something done, and this is enough to put Dillard's on my universe list, making a note that the retail department store group is showing extreme relative strength over the last 3 months, even though the industry group is still all the way down at 175. So that's kind of how the drill down works. You go from what's moving in from an industry group standpoint to what stocks within that individual industry are making some changes. And I'm going to scroll down here a lot. Here's another one, metal. We know metals have been volatile, but they really broke out. And you can see the big change in the EPS. The industry group is still 175, which doesn't give it a good ranking. But the 3-month relative strength has improved. Let's see, over the last year, we've improved from a 17 to a 6-month of a 29 to a 3-month of a 69. So again, we're looking for big improvements in relative strength and maybe big moves up in the industry group. Here's another one, software and security. This is a red flag. And again, this is why we want to stick to a stop discipline. Industry group 6 months ago was a 7, 3 months ago a 13. I mentioned proof point is standing out in the software security group, but the group itself is lowly rated at a 136 in its 3-month relative strength. Let's bring up the chart of that. And you can see the relative strength downtrend. When you start to have the 21 roll over and then you've got the 50 roll over, it's a group to avoid. So we would have been taking profits in any security stocks that we owned as they break these areas. Now you can see it's rebounding a little bit, making an attempt to get above the 21, and Proofpoint is acting well, but there really are no other stocks in the group that are acting well in the security realm. So again, we're just scrolling up here. Auto manufacturers have improved. Still lowly rated 143. That's in the lower third of it, but 3 months relative strength of 63. Relative strength really just being flat, and that shows terrible as a 28. But over the last 3 months, this goes all the way back to here. So compare where the relative strength was 3 months ago to where it is now. Nothing really jumping out at me, and this is still below a declining 200-day moving average, the overall group. Electronic parts, this is something that's improved a little bit. In fact, Jabil, I believe, is in this group. The group itself, not looking that great, but again, improved relative strength. Group all the way up from a 157 over the last 3 months to a 138, and improving near-term relative strength. Let me just pick up the pace here a little bit. Okay, electronic. Actually, this is the one that Jabil is in, electronics manufacturing. Another situation. This is still out. This is still in the lower half of the group, really in the middle at 100, but an 89 relative strength. Here's another one, apparel and shoes, that have improved year long, you look at relative strength of a 48, you think you don't even want to take a look at it. So I'm not a big fan of the fact that IBD uses the 1 year relative strength in its rating. I pay much more attention to the 6-month and the 3-month relative strength when I'm trying to find emerging leaders. And you can see here how this has improved from 3 months ago at 171 up to 103, and that is the group that Jabil's in. Wholesale electronics, another one that has jumped up from a 50 to a 95. So this is really the sweet spot. Once you get above 100, the groups from 100 to 60, this is really where I'm starting to look for standout performance. And here's one, retail building products, retail. That's shown some improvement from 103 last week to 86. And it's really, that's the exercise that we go through, trying to find emerging groups, understanding where the market is, understanding whether growth is outperforming value and whether small caps are outperforming large caps or vice versa, then going to the 11 spider sectors, then to the 33 IBD sectors, which are ranked in the paper, and then digging through the industry groups to see what's emerging leadership and what's leadership that was doing great but is now failing, and certainly the software stocks are a good indication of something that rolled over. And here's an example, software stocks, 84 relative strength over the last year, but only a 31 over the last 3 months. And this is a situation where right here, things just pretty much changed at the end of August into the beginning of September, and then here September 9th when you had that big rotation out of momentum and into value. Now they're starting to bounce. A lot of them are coming up into resistance. I noted out some of the outperformers now, and Coop are acting pretty well, Okta a little bit less, but all groups go through periods of in favor and out of favor, and it's a matter of avoiding the landmines and trying to find the emerging groups. So remember, you want to ask yourself, large, small value, large, small growth versus value. How are the 11 spiders doing? And then there's a multitude of ETFs that track these broader 33 sectors, and some that are very specific to the industry groups. But for some of the industry groups, you've got to, I have a whole separate list here of ETFs that I go through constantly. Let's go through that to see what stands out. ETF weekly. So the 65 of these, and it includes the large cap indexes, and then as I said, somewhere between the sectors and the ETFs and the industry groups are things, do I or don't I want to be in them? This is the transports. I'm constantly noting strength or weakness, relative strength or relative weakness in these groups. Retail, this was beaten down for a while, but this coincides with that early September night, September 10th. Retailer relative strength ticked way up, but there was no staying power. It's given most of it back. Biotech's been bad for an extremely long period of time, trending under the 200-day moving average. Semiconductors have held up extremely well in the tech arena. Banks have been big money flow into them at the beginning of September, given most of it back since then. Gold, this is something that we caught here. Now it's correcting, but forming a very nice consolidation. Consolidations should resolve to the upside. We've got positions in gold. It's holding the lows. This 140 area corresponds to about 1,500 on the price of gold itself, and it's holding above this 136.63 level. Very nice consolidation. Tim was talking to me about this morning. We do own GLD in multiple portfolios. Gold stocks, metals and mining, terrible. Oil, at metals and mining, this is primarily the steel components of it that are so bad. TLT bonds, we've got positions in bonds. They broke out here. They came back and tested, held support, and we took positions in bonds over the last couple of weeks. Small cap, here's the dollar. We always monitor this. The dollar continues to be strong, which is a headwind for multinationals. Biotech weak, home builders have acted very well. Look at the relative strength in this. Tim nailed an entry on this one, and that corresponded somewhat with interest rates. We're going to talk about that on the podcast this week. Correlation between different groups. Again, here's the SOX. Steel, this is going to look terrible. Yeah, this is what's dragging down metals and mining. See, every time it tests the declining 200-day moving average, it fails. Same thing with oil producers, oil services. Aerospace has been, notice the recent weakness. I pointed this out down to a 63 over the last 3 months compared to an 82-year wide. Relative strength still going sideways in there, but when you're going sideways, there are other groups that are trending higher, and that's why it's fallen from an 82 to a 63. Let's see, anything else in here that stands out? We always track bonds too. Here's Hack, the cyber ETF. Again, you can see that rolled over, and the relative strength has been declining. So Proofpoint is really one of the standouts that's acting very well, but the group overall not doing too well. A 31 over the last 3 months. If some of the other ones start to pull in the right side of their bases and they rise over the next couple of weeks, there may be some good attractive entries there. But right now we know Proofpoint is the leader in the industry. Let's see where that goes, and if other stocks drag it down or if it brings other ones up with it. Lithium, this was a hot ETF when everybody was saying you got to get into lithium. It's needed for the batteries. Well, the LIT ETF disagrees with that. You can see it's declining for a long term under the 200-day moving average. KWeb, very volatile. This is the big China names that are traded on the U.S. index and really having a hard time getting going with everything that's going on with the trade talks. IGV is software. This is the same situation where it's rolled over. Some selling in here, gone sideways for a little while. Look how it's going sideways, but its relative strength is going down. This reflects the move into value stocks out of these high growth software stocks. And now a little bit of a rebound. The question is it a dead cat bounce? We got above the 200-day moving, the 21-day moving average, but we ran into resistance at the 50. I have a position in this, but it's hedged with the Qs. I want to see how this shakes out. It's holding the 200, trying to get back above the 21 and the declining 50, but a bunch of the stocks have been acting better lately, and I showed three individual stock bases within the group that have potential for leadership if we can get any kind of strength back into this group whatsoever. It's also Cloud is another ETF that I look at very closely on a monthly basis. Poked its head, or on a daily basis, poked its head above the declining 21, failed yesterday, making a little bit of a move today, and again now is holding up very well, trying to come up the right side of its base. It's gotten back above the 21 and the 50, and I mentioned OKTA struggling a little bit. Coop is the other one that's acting pretty well. You can see this actually is trying to hit all-time highs. VIG is a dividend ETF. We track just about everything in here. Here's the value and the momentum. You can see the big move up into value and now giving a lot of it back since that early September surge. And here's momentum. You can see the big downtick there, really just moving sideways since then. It's moving sideways while the price is moving down. IBD 50 ETF. This is a good gauge for how growth stocks are doing too. Again, you can see the big move down corresponding with the debacle in early September, now going sideways, trying to make a little bit of a run. So that's how we evaluate sector rotation. Let's take a look at charts of some in-house holdings. Actually, I think I pretty much already did that, but let's talk about what's being held, I'll address the Grotection portfolio. Costco. This is also in the stock and ETF portfolio, acting really well. We took positions in this last week. Roku, also in the stock and ETF and Grotection portfolio. This was a nice little bottom that got put in here, held the 150-day moving average, but it also had this big area of support over here and pretty much got everybody out. These big red bars. This was all the hot money flowing out. Then it broke the 50-day moving average decisively on a big downgrade. Came down to this 100 area. Jesse Livermore talks about these round number areas, and you see it all the time. It battled it here, gapped above it, came down, held this support that was on the left side of the chart, started to make the turn at the 100 area, and now we got a nice gap up on an upgrade today, right into the declining 21. So this is the rubber meeting the road right here. Wouldn't be surprised to see a little bit of a pullback over the next couple of days with it. If it's extreme strength, it's going to make a run at the 50-day moving average. DocU, this is my largest position in Grotection right here at a 10% position. Somebody commented that might be, I commented on this in the video, but we know how leading stocks act. They behave in a certain way. A 10% position, realize that if it drops 10%, that's only a 1% impact to the portfolio. And it's really only giving back the profits that I've already got in it. This is showing all the characteristics of potential leadership if the market gets strong, and it's one of the first ones out of the chute. This huge gap up on volume after its earnings report, followed by 3 days after that. This is very rare that you see 4 straight days up. And you can see the relative strength shooting up. Then the market starts to pull in a little bit. It goes sideways. Low volume in this consolidation. Love seeing that. Touch the 21. Hey, the market reverses back to the upside last Thursday, and I took a position in it, followed through strength. One of the things I'm always trying to do is to add more money into my winners and cut the losers quickly. It's really just familiarity with how leading stocks act that allow me to be comfortable with taking a 10% position in an individual stock, and the relative strength is certainly bearing out the price strength also. Dollar General, the strongest in discount and variety. The group was terrible. It's certainly improved. I got stopped out of 5 during the pullback last week, but I had my eye on Dollar General, a sister stock for it. I bought this gap up. When the market started pulling back, it didn't act very well. Got a little bit of momentum up to this 137 area, but gave it all back during this market pullback. And then finally I got stopped out here. But DG in the same group was acting so much better that when we got the buy signal with that bounce off the 200-day moving average to put money to work, I just flopped that into a better acting stock in the same group, Dollar General. And again, this was a perfect buy off of the 21-day exponential moving average. It also gives me a very nice reference point for a stop. Always looking for low risk entry points. RH is another stock that was entered last week. Same situation, strong earnings, big money coming into it here. Pulled back during a market consolidation, held the 21, took my position here, and up several percent on it. And you can also see the relative strength bearing out the strength in the price. I did Costco. Nike is the 6th stock that's owned in the Grotection portfolio here. And again, this is another one with a gap up on earning strength, made a little bit of a move, some consolidation as the market pulls in. This is the S&P 500, this black line up here. This is the S&P 500, and holding this breakout area at 90 and the 21-day exponential moving average. Had a little bit of a shakeout, but held the 21 on the China news yesterday. But again, low risk entry point with this, and I always like when we have a good earnings reaction. I'm a little concerned about this with the NBA and China thing going on. Really, it's the sneaker companies that run the NBA, and See, as long as this holds the 21 and this 90 pivot, it's acting fine. I was also asked to chart the Fang stocks, and I'm going to do it using this comparison chart over a year-to-date basis. Actually, let me get out of that. I want to let's bring up the S&P 500 first so that we have a benchmark. And let's also add the NASDAQ 100 ETF on here. Okay, the Fang stocks, let's start with Facebook. So here we see that Facebook has been a very strong outperformer over the past year. This coincided with an earnings report back here. It's had some very tough pullbacks. For example, this was a 25% gain, culled all the way down to a 5% gain. Let me bring the time period up here at the bottom of the chart. During this May pullback in the markets, but righted itself, going sideways since then. Outperformer, struggling a little bit lately. Let's look at it on a daily chart. And this is another one that is stuck between the declining 50-day and 21-day exponential moving average and the rising 200-day moving average. So they've got earnings coming up in 4 weeks. If the market moves higher, I would expect this to move higher. If the market breaks down, I would expect it to break down. But it's really looking a lot like the NASDAQ 100, the QQQ lately. But you can see on here the outperformance of it since it had this earnings gap up. So that's Facebook, the F. Next we'll do Apple. Let's take a look at Apple on the daily chart first. Okay, great. My charts are slowing down here. Apple definitely a leader. We brought this up before, trending above the 21-day exponential moving average. And here's Apple, extreme period of weakness during the fourth quarter of last year. You can see it's flat over the quarterly period of time, but since this sell-off, relative strength has been improving, and it ends up just about where the S&P 500 is, but it certainly took a difficult path to get there. Next up, Amazon. This is another stock that has been struggling as of late. Let's look at it on the daily chart first. And this is below all the moving averages. Again, you can see the inability to get above the declining 21, and it's riding it lower. This all started with a disappointing gap down on its last earnings report. And you can see the accumulation distribution rating here of an E. Flat out, big institutions have been selling Amazon. Relative strength of 34. Where is it over the last... let's see where it is over the last 3 months. I have that in the NASDAQ 100 group. Amazon, 26 over the last 6 months and a 21 over the last 3 months. Let's take a look at the comparison tool. And you can see Amazon, this line here, kind of traveling with the NASDAQ 100 until recently. With its last earnings report, it started underperforming. Netflix, another, this again suffered in the fourth quarter, nice rebound, and then its last earnings report, very disappointing. You can see the gap down here in earnings report, and this is a classic case of support, this 342 area, which coincided with the 200-day moving average, turning into resistance. You had the gap down on earnings, a bounce into the 200-day moving average, and that was it. That capped it. And it's been rolling over ever since then, trending under this 21-day exponential moving average. The best bulls could hope for here. It did hold 250 in this last shakeout last week. If the 21 can turn and price get back above it and then get back above the 50, you can use this 250 as a stop out level. It should hold that, but it does have earnings next week, so that is something we'll be keeping an eye on. Google, definitely one of the better acting of the Fang stocks, and again, this coincided with its reaction to earnings at a big gap up on earnings that was immediately sold off as the market was pulling back. That's why I love this black line up here. When the stock is being weak, you just want to look and see what the market was doing. Was it being weak at the same time? If so, then you go to the relative strength line to compare what it's been doing to what the market's been doing. And this really has been doing about what the S&P 500 has been doing. Little sell-off, held the 200-day moving average, and now struggling to get back above the 21. Looks a lot like the QQQ. Microsoft is going to be the last one of these. You can see Microsoft in a very tight range. It needs to hold this 130.78 area. There's a saying, too tight for too long. This has been a very shallow 8% flat base. It may break above it, but if it breaks below it, I would be extremely concerned. I own Microsoft, and I've owned it for a long time with nice gains in the blue chip income portfolio, but I would wrap those gains up if it breaks below this 130.78 area. Let's add those to the comparison chart. Google. Come on, MarketSmith, don't you know that I've got a webinar going here? Well, I think you get the point. Google has been performing just about with what the NASDAQ 100 has been doing. Microsoft, a big leader. In a very tight consolidation, and just showing it on the comparison tool, you can see strongest gains. Here's your annual gains up here, or 52-week gains. Netflix down 24%, Microsoft up 22%. So when the NASDAQ is acting well, I like to own QLD, the 2 times the NASDAQ, when it's trending higher. You can see QQQ up 4%, but over the last year, QLD is only up 1.4%. During the downturns, QID is what works as a hedge, QLD, if you've got a strong uptrend with these types of stocks. So Q&A time now. We've got 5 minutes left. Any questions or charts on request, I will go through them, so feel free to type any of them into the question box. I was asked again about Roku. I addressed this, but this bottoming area here on prior support really got the attention, me and Tim's attention, and we took our entries in it over the past week and have been rewarded very nicely so far. Critical to see what happens when it comes up in here around this 21, declining at 21-day exponential moving average. Somebody asking about Team. This is consolidating nicely in a flat base, only a 20% base, very manageable. However, it is a stage 4 base, so it is a late stage base, and that's concerning. And software stocks have had a pretty big run, but again, looks a lot like the IGV. Tried to get above the 21, ran into the 50, still above the 200-day moving average. Twilio was a leader for a long time, broke down on its last earnings report. All rallies were sold into this 21-day exponential moving average. This is the most crucial moving average to me, the trend of the 21, and then 9.9 and 9.10, the big breakdown and the rotation out of momentum, and now it's forming a flat base under the 200-day moving average. That's a big negative. It's holding the 100 area, which is a positive, trying to right itself, relative strength, just going sideways now over the last 6 weeks, so that is at least a positive sign for it. But you really need to see it get back above the 21 and then see the moving averages suffice to say, yes, it's got big growth, but now Okta and Coop are definitely acting better than Twilio. TDOC. I have I have a love-hate relationship with this stock. This acts very well sometimes, and then it will just flat out fail and go into the trash can. Here's an attempt to break out from this nice flat base, stage 2 flat base, big volume, looks great, but then the market started to pull in, and this pulled in a lot harder than the market pulled in. So we went from 74 all the way down to 54 here, broke the 200-day moving average, started to build the right side of the base, was looking very good, got back on my watch list, and a very harsh correction during the last week and a half coming down. The positive is that it held the 200-day moving average, and this is forming a handle, but you don't want to see big volume in a handle. This is a flaw in the handle of this base. The volume should be like you see here. Maybe a big breakout on strong volume when it next reports earnings. Earnings apparently the beginning of November. But as I said, I don't like stocks that go from 73 to 60 over a week and a half. I can never get a decent enough size position in it for me to be comfortable with. But it's a great story, and the story is so great that some of the big insurance companies are creating their own models of Teladoc and getting their own physicians on board for people to just call in. In fact, that one of the last sell-offs was tied to I'm pretty sure I bought this breakout and it failed and I got stopped out on TDOC, and it was tied to United Healthcare coming up with their own physician on-call model. So competition coming into it, not a lot of barriers to entry to this. It's just a matter of who the doctor's going to work for if you're wanting on-demand healthcare. Do like the idea. They still lose money. They do have nice sales growth. Let's go down and see their sales growth, 38%, 40%, 59% over the last couple of quarters. They still have a negative return on equity, and they are not a profitable company. NVIDIA, let's take a look at NVIDIA. We've got time for a couple more after this one. Yeah, this got my attention definitely, but this was a shooting star or a evening star reversal, which means you're going up, you have a harsh reversal, and it's confirmed the next day. But the reversal was because of the China news, and it did hold the 21 on the pullback. I'm watching the video. You can see while it's PE of 37, and its fiscal year ending January 2020, they had negative earnings growth. It goes back to 32% projected earnings growth. With a PE of 37, that's not an unreasonable valuation for this. And earnings are still a way out. I'm in IGV. If IGV works, this is going to work. I kind of like the way this is forming, and the big thing, the big positive, this is now a stage 1 base because this brutal action in it, and again, this is another don't hold on to your leaders too long. This action undercut its prior base, which makes it stage 1, which makes it very attractive if it starts to work again. Any other questions or tickers? This is your last chance. Otherwise, we're going to wrap it up. And anybody that sent out or has been watching this live, you will get a recording of it at the end of the day. And I've got a lot of people on the recording list for it, but I enjoy doing these. It's a little stressful sometimes putting it together, but I know people enjoy it, and we're really big on education here at Revere. So thanks everybody for listening, and have a great day. Be on the lookout for your archive of this.